So happy to see you all again. Today, we're jumping into something super exciting. Trust me, you won't want to miss this. Considerations for mutual fund plans with a monthly salary of $25,000 in India. At this income level, the key is to prioritize building a strong financial foundation while consistently investing a manageable amount. Prioritize an emergency fund. Before you start investing heavily in mutual funds, ensure you have an emergency fund equivalent to at least 3 to 6 months of your essential living expenses in a readily accessible, low-risk account like a savings bank account or a liquid mutual fund. This fund acts as a financial safety net and prevents you from having to sell your long-term investments during unexpected financial needs. Determine your investment capacity. A common guideline often seen as the 72-15-15 rule for a $25,000 salary suggests 70% for living expenses, approx. $17,500. This covers all your necessary monthly expenditures. 15% for emergency fund, approx. $3,750. Dedicate this to building your emergency corpus until it's sufficient. 15% for SIP investments, approx. $3,750. This is your regular investment amount. This is just a guideline. You might be able to save more by optimizing your expenses. A crucial part is to commit to a systematic investment plan. Even starting with $500 or $1,000 per month is a great beginning. Define your financial goals and investment horizon. What are you saving for? Short-term 1, 2, 3 years. Goals like buying a gadget, a small vacation, or a down payment for a two-wheeler. Medium-term 3 to 7 years. Goals like higher education, a substantial down payment for a house or a car. Long-term 7 years. Goals like retirement planning, child's education, or wealth creation. Your investment horizon heavily influences the type of mutual funds you should choose. For long-term goals, you can take on more risk for potentially higher returns. Understand your risk tolerance. Low risk. You want to protect your capital and are okay with lower returns. Moderate risk. You're comfortable with some market fluctuations for potentially better returns. High risk. You're willing to accept significant market volatility for the potential of substantial long-term growth. Suitable mutual fund types for a monthly salary of $25,000. Given the typical savings capacity and the importance of long-term growth for someone starting their investment journey, here are some generally suitable mutual fund categories. For emergency fund, very short-term. Needs. Liquid funds. Overnight funds. These are the safest mutual funds, investing in very short-term money market instruments. They offer high liquidity and aim to preserve capital. Returns are generally slightly better than a savings account, good for parking your emergency fund once it's built up beyond basic savings. For long-term wealth creation, index funds. Why? These are passive funds that simply aim to replicate the performance of a specific market index. They have very low expense ratios because they don't require active management. They offer market-linked returns and are an excellent starting point for beginners. They provide broad diversification across the largest companies. Risk profile, moderate. Investment horizon, long-term to ride out market volatility. Flexi-cap funds. Why? These funds offer the fund manager the flexibility to invest across companies of all market capitalizations. This allows them to adapt to changing market conditions and invest wherever they see the best opportunities, providing good diversification and potentially better returns than pure large-cap funds. Risk profile, moderate to moderately high. Investment horizon, long-term, large-cap equity funds. Why? These funds invest primarily in well-established, large companies that are leaders in their respective industries. They are generally less volatile than mid- or small-cap funds and offer relatively stable growth. Risk profile, moderate. Investment horizon, long-term. LS funds. Why? If you are looking to save tax under Section 80C of the Income Tax Act, ELSS funds are equity-oriented mutual funds that come with a 3-year lock-in period. They offer potential for long-term growth along with tax benefits. Risk profile, moderate to moderately high. Investment horizon, minimum 3 years, but ideally longer for optimal returns. Sample allocation strategy. Assuming you allocate $3,750 per month for SIPs and have a long-term horizon, the moderate risk appetite. Option 1. Simplicity and broad market exposure. $3,750 in a Nifty 50 index fund or a Sensex index fund. Option 2. Balanced approach with active management. $2,000 in a flexi-cap fund. $1,750 in a large cap fund or an ELSS fund. Option 3. Gradual diversification. Start with a flexi-cap fund for the first few months. Once comfortable and your SIP amount potentially increases, you could add an index fund or consider a small allocation to a mid-cap fund. Key investment habits to cultivate. Start early. Compounding works wonders over long periods. The earlier you start, the more your money can grow. Invest regularly. Consistency is key. It helps in rupee cost averaging, meaning you buy more units when prices are low and fewer when prices are high, averaging out your purchase cost over time. Increase SIP with salary increments. As your income grows, try to increase your SIP amount annually. Even a 10% annual increase can significantly boost your corpus. Stay invested. Resist the urge to withdraw during market downturns. These are often the best times to invest more. Review periodically your portfolio once a year or every few years to ensure it aligns with your goals and risk tolerance. Remember, the goal is to develop a disciplined investment habit that helps you achieve your financial aspirations over time. Thanks for tuning in, friends. Really appreciate your support, so don't forget to like and share the love. Subscribe. Catch you soon with more fun videos.